welcome to the deep dive. You, our listener, shared a really interesting piece with us. It's called "The More It Tanks, the More I Say Thanks." So our mission today, well, it's pretty straightforward. We want to pull out the key ideas from this, let's say, contrarian view on market downturns.
Yeah, moving past the usual sort of panic and fear headlines you always see.
Exactly. And hopefully equip you with some genuinely useful insights.
Precisely. We're not just, repeating the news cycle here. We're trying to explore a different way of thinking about these market corrections.
Right.
Not seeing them purely as disasters, which is the common reaction, but maybe, just maybe, as fertile ground for long-term gains.
So this source offers a valuable alternative, doesn't it, to how people often react emotionally.
It really does. And understanding this shift in perspective can be, well, a real game changer for you.
Okay, so the core idea, it's a total flip, isn't it, on how most people react when, they see those red arrows flashing on their investment apps. Instead of hitting the panic button and I don't know, doom scrolling all night, the author's basically saying, bring it on, almost welcoming it.
It's that image, isn't it? The discount aisle of capitalism. That really resonates.
It does fit with you.
It's a powerful way to reframe things. The author is directly challenging that deep-seated fear response, the one that kicks in automatically when the market drops. They're pointing toward those potential once-in-a-decade bargains that can appear when everyone else is, running for the hills.
It's not about pretending the downturn isn't happening.
Not at all. It's about seeing that same reality, but through a different lens, a lens of opportunity, essentially.
Okay, and this is where it gets really interesting when we look back at recent market history. Yeah.
Absolutely.
The piece mentions that speculative frenzy back in late 2021, you remember all the SPACs, meme coins, NFTs?
Oh, yeah. Hard to forget.
It almost feels like that was setting the stage for what came next in 2022. The inflation, rising interest rates, the big tech stock slump.
Precisely. That period of exuberance in 2021, it serves as a really crucial backdrop.
How so?
Well, think about it. Those who jumped in and bought into the hype then at those really inflated prices,
right,
they likely felt the pain of the 2022 downturn much more acutely. It just highlights the risk of, chasing trends without a solid reason why.
And that leads to this really blunt line in the piece. You only cry when you bought too high.
Oof, yeah. Direct.
It is. But it captures it perfectly, doesn't it? That the pain you feel in a downturn often stems from an earlier mistake, basically, overpaying to begin with.
That's a key insight.
So the dip itself isn't the real villain, maybe. It's the entry point.
That's what the author implies, yeah. And conversely, those who showed a bit more restraint during that speculative bubble maybe held onto some cash, some dry powder, as they say.
Yeah.
They were in a much better spot to actually benefit from the lower prices that came along in 2022. It just underscores the long-term advantage of, disciplined investing versus chasing those quick, short-term gains.
Okay, let's shift gears a bit and talk about the emotional side of investing. It's a roller coaster, right?
Always.
The piece talks about emotional investors who sell during a panic and how that selling actually creates something called exit liquidity. Can you dig into that a bit?
Yeah, it's a fascinating dynamic. It's sort of the unintended consequence of that fear-driven selling.
Okay.
So when a whole bunch of investors panic and rush for the exits all at once, they obviously drive prices down further, yes.
Right, makes sense.
But they also inadvertently create the opportunity for others, those with a longer view, maybe a more rational approach.
Contrarians.
Exactly. They can then step in and buy those same assets, but at much lower prices. So the emotional sellers, in their rush to get out, they're basically providing the liquidity, the ability to trade for the contrarian buyers to get in.
Wow. Okay, that immediately makes me think of Warren Buffett's famous line, be fearful when others are greedy and greedy when others are fearful.
The classic. Yep.
The author points out, though, that while tons of people quote that,
everyone quotes it.
Actually doing it when the market's tanking and everyone's freaking out, that's a completely different ballgame.
Oh, absolutely. It's one thing to nod along when things are calm, quite another to act on it when your own portfolio is bleeding red.
Yeah.
The author uses that clever dating analogy, too.
Right. Chasing the popular stock is like facing tons of competition.
Whereas finding value in the overlooked assets, the ones nobody's paying attention to, that can lead to much better long-term relationships. Or, returns in this case.
So the piece then moves on to this idea of wealth transfer during downturns, It's not like the money just disappears into thin air.
No, exactly. It changes hands.
So who's usually on the losing end of that transfer and who tends to benefit?
Well, if you connect the dots, downturns often see wealth move away from, say, those who are over-leveraged, maybe facing margin calls that force them to sell at bad prices.
Okay.
And also away from those who just give in to the panic and sell low. It moves towards investors who keep that longer-term perspective, who have the financial flexibility, and importantly, the psychological strength.
The mental fortitude?
Right, to buy quality assets when they're marked down. The author's point about being the vacuum instead of the falling chips really nails
Being the vacuum. Okay, so how do you actually become that vacuum then? The article highlights dollar cost averaging. That's a key strategy.
It is.
For listeners who might be newer to this, can you break down how it works and why it's so powerful, especially when things are volatile?
Sure. Dollar cost averaging, or DCA, it's actually a really elegant and simple strategy.
Right.
You just invest a fixed amount of money, say $100, $500, whatever fits your budget at regular intervals, like every month or every 2 weeks.
Regardless of the price.
Regardless of the price, that's the key. So when the market is down, your fixed dollar amount buys more shares or units of whatever you're investing in.
No.
When the market is up, that same fixed amount buys fewer shares. So, like the author says, you're literally farming more ownership when prices are lower.
Farming ownership. I like that.
And the beauty of it during downturns isn't just that you might get a lower average purchase price over time. It's the discipline it forces. It automates the process, takes the emotion out of it, and can stop you from panic selling at exactly the wrong moment.
And the piece mentions that even though it might sound, well, boring.
It does sound boring. No thrilling market timing here.
Right. But it often beats trying to perfectly time the market lows and highs, which, let's be honest, is basically a fool's errand for most of us.
Absolutely. For almost everyone, I'd say. By just consistently putting money to work, you sidestep that whole emotional game of trying to guess the bottom.
You just smooth things out.
You smooth out your entry points over time, yeah. And you position yourself to benefit when the market does eventually recover. The math just works in your favor, buying more shares when they're cheap.
This connects to another really counterintuitive point the author raises. This, irrational behavior of hating sales when it comes to the stock market.
Yeah, the Nike analogy.
Exactly. If your favorite sneakers went on sale, 30% off.
You'd be lining up or clicking buy now frantically.
Right. You wouldn't be trying to sell the pairs you already own in a panic.
It highlights this weird psychological disconnect, doesn't it? We love bargains everywhere else in life. Department stores, grocery stores.
Everywhere.
Yet when the stock market, which represents ownership and actual real businesses, goes on sale, fear just completely takes over for so many people.
The author really questions that. Why do we prefer buying high and get scared of buying low when it's companies we supposedly believe in?
It's a great question. And it ties into conviction, doesn't it?
How so?
Well, the piece suggests that if you truly believe in a company for the long haul, a drop in its stock price, assuming the underlying business is still sound.
Right, assuming nothing fundamental changed.
Exactly. Then that price drop should actually strengthen your desire to own more, not weaken it. Unless, of course, your initial reason for buying was just, FOMO, fear of missing out.
Okay. So if the story hasn't changed, the sale price is just better.
Precisely. A temporary dip in the stock price doesn't necessarily alter the long-term prospects of a solid, well-researched company. If your original investment thesis still holds water, then a lower price is simply a more attractive entry point.
Okay, another angle the piece brings up is the stability you can get from dividend-paying stocks, especially when the market's choppy. How do dividends fit into this thank the tank idea?
Dividends add a really interesting layer. What's quite reassuring about solid dividend payers during downturns is that those dividend payments, they often just keep coming.
Like clockwork, hopefully.
Well, ideally, yeah, from stable companies. So they provide this steady stream of income even when the stock price itself is bouncing all over the place.
Okay, that makes sense. Income stability.
And there's more. When the stock price falls, the dividend yield, which is the annual dividend payment divided by the current stock price, actually goes up.
Oh, right, because the price is lower.
Exactly. So during those downturns, you're potentially getting a higher income return on your investment for every new dollar you put in, or even on the shares you already own relative to their current market price.
So the author suggests maybe shifting your focus a bit.
Yeah, maybe less obsessing over the daily ticker price and more appreciating the consistent income being generated by your investments.
The piece really hammers home this point that navigating downturns successfully, it's often more about psychological strength, about mental fortitude, than about having some super complex financial model.
That's a huge part of it. It's about battling your own brain, essentially, your own fear-driven instincts.
Our brains aren't really wired for this, are they?
Not naturally, no. We have this thing called loss aversion. We feel the pain of a loss much more intensely than the pleasure of an equivalent gain. So market volatility, those downswings, they trigger that primal fear response. It feels dangerous.
But the author argues we need to overcome that.
Yes. They point out, quite rightly, that overcoming this aversion to temporary drops, temporary discomfort, is absolutely crucial for building long-term wealth. Volatility isn't an anomaly. It's a normal, necessary part of how markets work and generate returns over time.
So it's about retraining your brain almost.
Yeah.
Training it to see those drops as well as opportunities.
That's the goal, yeah. Easier said than done, of course, but that's the mindset shift.
And it's not just theory. The author backs this up with some powerful historical examples, doesn't he? People and companies who didn't just survive crashes, but actually thrived because of them.
Absolutely. Those examples are really instructive. You've got Warren Buffett famously making huge, savvy investments during the 2008 financial crisis when everything looked bleakest.
Right, buying Goldman Sachs, Bank of America.
Exactly. Then there's Jeff Bezos and Amazon pushing through after the dot-com bubble burst when so many other internet companies just vanished.
And we were definitely contrarian then.
Hugely. And think about Elon Musk navigating Tesla through its incredibly challenging early years, periods of intense doubt and financial pressure. These stories aren't just about survival.
No.
It's about recognizing and actively seizing opportunities when quality assets are undervalued because everyone else is panicking or retreating. It powerfully underlines the idea that some of the greatest fortunes are often built during these periods of maximum pessimism.
So if we try to boil it all down, what's the absolute core essence of this? The more it tanks, the more I say thanks philosophy. What's the fundamental shift?
I think the absolute core is reframing. It's about consciously shifting your perspective on market downturns, seeing them not primarily as threats to be feared and avoided, but as potential opportunities for building long-term wealth. It rests on a few key principles, really, like understanding that fear is usually temporary, but ownership in good businesses can be long-lasting, realizing that lower prices don't necessarily mean lower value, and viewing market crashes less as catastrophes and more as invitations to buy at a discount.
Invitations to buy, okay. And for listeners who like things really concise, the piece wraps up with a TLDR, too long, didn't read section.
Yeah, nice little summary.
What are some of the key action items from that?
It gives you a really practical checklist, things like stop the panic selling, actively look for the sales signs in the market, consistently use dollar cost averaging.
The boring but effective strategy.
The boring but effective one, yes. Focus on owning real, sustainable businesses, not just tickers. Appreciate your dividends if you have them. Try to tune out the day-to-day market noise.
Easier said than done sometimes.
Tell me about it. But crucial and fundamentally, buy when things look scary. And, well, thank the tank. The final line is pretty punchy, too.
What's that?
Still scared? Good. Now go buy something.
Okay, direct advice there.
Yep.
So as we wrap up this deep dive into this contrarian perspective, what's maybe the single biggest insight you hope our listener walks away with today?
For me, the crucial takeaway is realizing just how powerful adopting that contrarian mindset can be. Learning to see opportunity where most people only see risk during market downturns. That can genuinely be a catalyst for your long-term financial success.
So it's about prioritizing rational action over emotional reaction.
Exactly. Value-based decisions, long-term thinking, overriding that initial fear impulse.
That's a great summary, and perhaps leaves you, our listener, with something to think about. Considering these principles we've just discussed, maybe ask yourself, how might you consciously approach the next market downturn differently? Or perhaps what are some specific companies or sectors out there that you believe hold real long-term value, even if their stock prices were to take a temporary hit? Food for thought. Thank you for joining us for this deep dive.